Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Welcome, everyone, to Multifamily Rockstars. On today's show, we have Mark Allen. Mark Allen is one of the leading investment sales brokers in DFW. He is a West Point grad, and he recently wrote a book on real estate. So really excited to have Mark on the show today. Mark, welcome to the show.
Thanks, Ryan.
So let's jump right in. Mark, why don't you tell the listeners a little bit about yourself?
Sure. So I grew up in Orlando, Florida, and at 18, I wanted to go off to college and play football. So that was my main, I would say was my main goal in life at that point. A little lost 18-year-old. But anyways, that led me to West Point, the United States Military Academy, and no regrets there. Just an incredible experience. It's a leadership and it's a leadership factory. They crank out some of the best leaders in the world. So I was humbled to be surrounded by, incredible, diverse group of people, not only from a instructor or leadership perspective, but also, my peers, guys and girls that were just incredibly well-rounded. So anyways, I went to West Point, and when you go to a military academy, you've got to pay back your education by serving this great country in the U.S. Armed Forces. So I was in the U.S. Army for about 5 years and then got out. But while I was at West Point, I got a career starter loan. It was $35,000 at a 0.5% interest. And my dad was in the real estate industry. He was a developer and builder on the single family side. And, I had seen multiple market cycles. And he said, Mark, this is opportunity. You need to take this money. We actually, I think we need to try to go get more money and buy real estate. And unfortunately, he put all of his eggs in one basket, and he was building multi-million-dollar spec homes, and he couldn't sell those homes. So long story short, I took a big hit on his credit. He did have some that were moved at a probably 40, 50 cents on the dollar. By a company called National Loan Acquisition Company out of Oregon. So he knew there was opportunity. He didn't have the means to go out and get any loans based on what had just happened. And we went around to multiple banks, and they're like, well, you're in college. You don't have any credit, and you don't have any credit, Dad. So anyways, that didn't work out. So I had this $35,000. I bought a foreclosure. It was $20,000, 2-bed, 2-bath condo. And I rented it out for $750 a month. Had no mortgage, so I was cash flowing well minus my HOA fee. And I said, this real estate thing's pretty cool. How do I scale this? How do I continue to buy properties? So from there, I was out in the Army and was doing wholesaling, just creative strategies, little to no money. I had a $45,000 salary as a second lieutenant. So my dad was his business was still recovering. So he was just starting to get his head out of water probably in 2012, 2013. So he couldn't help me all that much. But yeah, I scaled a single family rental portfolio, started doing flips, and then started partnering with my dad because he had some net worth and liquidity. We worked with a community bank, which provided us great fix and flip loans at about a 6.5% interest rate. Interest only deferred for the first 3 months. So we did some deals together, and then, I hit a point where essentially I was like, I want to be able to scale this. I want to go, well, not scale in the flipping. It's just too active. I want to be more passive. The reason I got into real estate was to create margin in my life. And, the active wholesaling and flipping just wasn't cutting it. So anyways, that led me to multifamily, and here I am being extremely active as a broker.
Sure.
But I'm passively investing in deals as a limited partner at the moment. And I look forward to what's to come.
Awesome. Yeah, Mark, that's a great background. Thanks for sharing that with us. Let's dive into how you became a broker and why.
Okay. So I met some other multifamily brokers One is now my business partner, Todd Franks. And, I said, hey, I want to buy multifamily. And that was actually the reason for the meeting. And they said, me not knowing really anything, and I was just trying to understand what was going on in the multifamily space. I networked with some local syndicators who are, part of some of the local Dallas-Fort Worth mentor groups. And so I was learning a little bit from them. This was, 2015. And anyway, so I met Todd Franks, and he said, why don't you broker multifamily? You can learn, continue to network, and, one day, buy your own. So it'll help with the transition. So, that's really what led me in. And I had my foot in the door to come right in. There's some barriers to entry to enter the multifamily investment sales space. Typically, you got to start at the bottom. I was 29 years old at the time. And, definitely have to, I know a friend of mine actually works for HFF, and he had to start as an analyst as a 31-year-old. So I felt fortunate to be able to step right in as an investment sales broker and not have to start as an analyst and work my way up.
Well, that's great. That's great. What do you like about your job?
Every day is something different. I get to work with incredible people like yourself. It's the gamut. Right now, the majority of the buyers in the market are syndication groups. So you have, I'm really in the private space, so call it 3 million to maybe 25 million or so. And middle market, I would say, is above that today, where you're working with bigger companies.
Sure.
So I get to work with men and women who have just great stories. They started with maybe a duplex or a quad, and then, grew it into just, big portfolios. And just to hear their lessons learned and their stories. I really like that part of the business. It's a people business at the end of the day. So I really enjoy connecting with the people in the industry.
Awesome. Thanks, Mark. So let's dive into brokerage. So walk us through the process of how you get a listing.
Yeah. So, it's really, again, I said it's relationship business. So people want to do business with those they know, like, and trust. So for me, it's continuing to add value to investors. If they're active buyers in the market, that may be supplying pocket listings, pre-listed deals that may be open to preempt, with an offer prior to the marketing process. Maybe that's an off-market deal. So just, continuing to put deals in front of investors who are looking to buy. Maybe that's an owner that's a long-term holder, and it's just keeping them up to date with facts of what's going around their property. If we sold a property close to there, it's just a simple data point as to what the sales price was. So they're tracking the market. It can be a variety of different things, but it's how do I add value, and then turning that value into relationships.
Sure.
And then whenever it's time to sell, they think of me.
Awesome. And then in terms of, you said, you didn't have to start as an analyst, you kind of jumped in right as an investment sales broker. Now, what type of support staff do you have behind you to, put together the BOVs and the OMs and so forth?
Yeah. And that is ever changing. Right now we have 10 brokers. So we're we're really busy. We're staffed up. We have a transaction manager who manages the entire escrow process, and some of the back office admin tasks relating to our proprietary CRM. We have a marketing director and a marketing coordinator who support with developing all the broker opinion values or broker price opinions, basically the listing presentations, also the offering memorandums whenever we come to market with properties, and our office blog, our website management, social media, so on and so forth. We also have an analyst who's been with us for a couple of years now, and he continues to improve on our underwriting model. It's a continuous improvement project for us, but he's analyzing and underwriting all the deals. Usually provides the broker with kind of a 90% solution, and then we take it from there and tweak it based on what we know about the property and some of the surrounding comparables.
If you were to look at your typical week, how do you break that down in terms of, buckets of time and where you're spending that time?
And it's always changing, which is one thing I like about the
Sure.
job. And, I have a plan every day. And what's the old Mike Tyson quote? Everyone has a plan until they
Until
get
they
punched in the mouth.
face.
Well, I get punched in the face, every morning at 9:30, and my whole day is disrupted. But I would say a typical day is I block out time to make my phone calls. And for a broker, turning those calls and meetings. So I think many of us are KPI driven, key performance indicators.
Mm-hmm.
We have an equation that so many calls leads to so many meetings, which leads to so many listing presentations, which leads to so many listings. So, we're diligent about tracking our key performance indicators. So those calls are really crucial. I tend to block out 1 to 2 hours a day to make my calls. Of course, there are times when I'm touring properties, so that's part of my day. There's times when I'm just tweaking broker price opinions, from the package, little editing and some things like that. Preparing OMs, I'm just making tweaks and final edits. Meetings, it's a big lunch meetings, coffee meetings. Meetings in the office in the afternoons, just whenever I can get FaceTime with investors is great. So yeah, that's about the majority of my day.
Awesome. And then you mentioned underwriting. You touched upon that a little bit. If we can, dive into that a little bit more. So just walk us through your underwriting process when putting together a BOV, and is that different from when you're putting together an OM?
Yeah. So if we're going to do a formal broker opinion of value, I hear broker opinion of value, BOV is probably the common term. I hear broker price opinion too.
Okay.
They're synonymous. So the first thing we'll do is, ideally you drive the property, figure out what are the competing properties in the area. So you're able to drive the property, shop it or tour it with the owner. Also shop the comparable properties, understand, if you can get on site, great, but obviously you can use the internet as a resource. The website has probably plenty of pictures out there, depending on the asset. Maybe there's some mom and pop ownership and they don't even have a website. But that's a crucial step, just to understand the micro location, the property, and its competing set of properties. And then it's collecting all the rent data. So doing your rent comparable summary. It's starting with the sales comparable summary for similar vintage, ideally sold in the last 12 to 18 months.
Okay.
Within it really depends on the area. If it's like Waxahachie, Texas, you're probably going to have to stretch a little bit farther for sales comps.
Sure.
North Dallas. So it's finding those sales comparables, then uploading the rent roll, the trailing 12 profit and loss statement. And for us, it's basically building our unit mix, just capturing the effective rents. What are the average in-place rents today? Also, what are their asking rents? And where can we, with renovations, where can we take the rents? And then from there, it's just, I could get into the weeds here, but
sure.
We're breaking down the current income, the current expenses, and also pro forma income, pro forma expenses, and vacancy and other income, so on and so forth. And we're really driving to both looking at a cash on cash return at a project level and an investor level, and then also an internal rate of return, an IRR. For the most part, we're running, because the majority of the buyer pool is syndicators, and they're running a 3 to 5 year model. So we tend to run a 3 to 5 year model, but that changes too. It can change depending on and I'm talking specifically value add, because we focus majority of our efforts on Class B and C value add. It may be different if it's a 2015 year of construction. Maybe investors are coming in with 10 or 12 years, like full term IO, and they're going to hang on for a longer term. So it just really depends on the asset.
And then when you said you try to solve for a certain cash on cash return, a total return, what kind of metrics are you solving for there, Mark, to make it attractive to the seller and to the buyer?
As far as like target yes. Cash on cash returns. Again, depends on the asset, but I would say in today's market for a value add deal, it's going to be probably year one, a 6% plus. cash on cash return. Year 2, I mean, ideally you're 7 to 8%. And then year 3, you're 8 to 10% and beyond.
Okay.
Again, depending on quality of location, quality of asset.
Sure.
So it's definitely, I would say there's not like a formula for it. It's an art, not a science.
Sure. Awesome. Okay. And then you talked a little bit about, preparing these BOVs, opinion of values, for the sellers and managing buyer expectations. So how do you bridge that gap between what sellers want, what buyers want, and the price expectation gap there?
Yeah. I mean, I would say we're really spot on when it comes to, at least for listings, and based on just tracking investor return expectations. So I think our list to close ratio currently is like 100.6%
Okay.
Over the trailing 12 months. So,
and maybe just explain that to the listeners, what that means and why.
So if we list based on what we signed the listing agreement at, of course, for the most part, the majority of assets that are being put out to market are listed at a market price, and the market will determine, but the broker will have a whisper or guidance. And a lot of times that whisper or guidance, and it could be played with depending on the broker and their strategy. But if we value a property at 10 million, that's what we sign a listing agreement at. So if it sells for 10 million, then we're 100% list to close ratio.
Perfect. Yeah.
Thanks
for that. No, that's excellent. I mean, it sounds like you're pricing it to where it needs to be priced to move, and it's perfectly meeting seller buyer expectations.
Yeah. And I mean, it's a challenge sometimes because there are sellers in the market that maybe aren't as sophisticated. And they may hear brokers, surrounding properties selling for $100,000 a unit. And, they hear these constant sales, but maybe they own or manage, that their rents are not near as high as some of the competing properties that are selling at that level, but they still expect $100,000 a unit. So that could be a challenge for us sometimes, but it's hopefully the other brokers and their opinions of value are in line with ours. And we have a term in the industry that some brokers buy listings. They'll really overshoot the value and try to prove out the market and just say, hey, like, this is what the market says it's worth. Like, sorry, we overshot it a little bit, just hoping that they'll accept the offer because this is where all the offers came in.
Sure. And then, for the current market, are there owners out there that are just holding back? They're not selling, whether, they're finding it, hey, I'd like to sell my deal, but where am I going to redeploy my capital? So just walk us through kind of what owners are thinking in this market.
Yeah. I mean, that's probably our number one objection is, well, what am I going to do with the money? And, my property is cash flowing very well. And I mean, it's something that we come across quite often. And some are, they know what prices are doing in the market. Maybe they bought earlier on in the cycle, or maybe even last cycle. And, even from last cycle, if you were to buy in 2005, 2006, and you hear the prices today, they're still like double of what it was 15 years ago. And I don't know, they just have a hard time with cap rates and wrapping their head around that, because they bought at a time when the competition was not as fierce. So in their minds, it really depends on the owner too. Some of them are only multifamily investors, and some of them are very diverse. They can buy, they understand office, they understand retail. So we have some clients that are exiting multifamily right now. Okay. Because they can go buy a shopping center at a 7.5% cap rate, and that's 2004 year of construction. Obviously there's different risks with shopping centers, but they understand that asset class and understand the risk that that's there.
And they can 1031 into the shopping center if they sell them.
Right. And they'll execute a 1031 exchange to defer capital gains.
Okay. Got it. No, I appreciate that. So, you mentioned earlier you invest in some deals as LP. Walk us through, the 3 to 5 things that you look for when you're investing in a deal.
Okay. First would be sponsor. That's number one. I need to know who they are, trust them. And I mean, it's easy for me as a broker in the market because I know who's active and I know who's been around a long time. So it's not only, trusting the sponsor, but what's their experience level. That's number one. Number two would probably be location. I mean, at this point in the market cycle, I'd prefer to be in a probably B or better location.
Okay.
I do like some of the suburban markets, like the Weatherfords or the Burlesons, Waxahachie, Ennis.
Okay.
It seems like, a lot of those don't have as much multifamily stock in those submarkets, and they've seemed to be performing well over the last 3 to 5 years. And many of them have great growth stories just because, land is so cheap out there, relative to what you can find in the Metroplex.
Okay.
And because of that, there's been a lot of, retail growth, new jobs entering just because it's more affordable. So, each little city probably has their own story. So I would say that. And then obviously, I would say returns is probably the next thing, or price story.
Okay.
Maybe story than price. I mean, obviously I like an off-market deal where you're not competing on the market.
Okay.
Who's the seller? I mean, are they sophisticated? Are they unsophisticated? Typically you find a lot of opportunity with mom and pop ownership. Maybe they self-manage.
Sure.
So yeah, that, and then price would be the other one. I mean, what's the basis of the property? Our properties are around there selling for, again, 100,000 a unit, and maybe you're buying at 80,000 a unit. Cap rate, I'm not really, as concerned with.
Interesting. Okay.
Yeah, I'm not really as concerned with cap rate, but if they're buying at a 3.5% cap rate and it's 80 a door, and it's mom and pop ownership and it's off market and everything else is trading for 100 to 105 a door, I really like that.
You like that story? Yeah.
Yeah. Because you could put 7,000 unit in and still have quite a bit of spread there.
So how much stock do you put into price per door versus price per foot?
I look at both. I think people can get blinded, by the price per door. So I look at both for sure.
Okay.
I really like townhome style properties that have larger units, nice. But people can say, oh, well, that's 130 a door for sure. Townhome units, but maybe they're 1,400 square feet each, and sure. The rents are 85 cents a square foot. Maybe they could be $1 a foot or something like sure. that, sure. And it's like $80 a foot when I see Class B properties trading between 120 and $150 a foot. So yeah, I mean, it's something I definitely consider.
Awesome. And so you mentioned off-market deals. So just walk us through, what those are, and, how do you personally decide to whom you show those off-market opportunities or pockets?
Okay. Yeah. So off-market deals are many times there are owners that don't want to sign an exclusive agreement, and they would prefer to go off-market because of their staff has been there for maybe they've owned the property for 15 years and they've had staff members that long, and they don't want to inform them of the sale. And maybe the staff members say, hey, well, I'm going to start looking for another job. They pick up and leave, and the operations go down the chute. That's a common story, but maybe it's just there's a lot of brokers right now in the market, and they bring 1031 exchange buyers, and many owners, or maybe they throw out a price and they're like, wow, okay, I mean, that's probably what we determined to exit at, or a little bit under that, and so they end up getting their price that way. But anyways, an off-market deal is a deal that is not fully exposed to the market. Typically, there's between one and several buyers chasing after the deal. And, but I don't know, a lot of times you'll see off-market deals too, that owners are like, yeah, if I could get 120 a door and it's only worth 100 a door.
Sure.
I'm sure you see those.
Yes. For you personally, when you have an off-market opportunity, there's only so many people perhaps you can show it to. How do you decide who you want to show that to?
I would say, so for me, it's credibility, number one. It's surety of close. that goes along with credibility. Credibility in the sense that they can move quick. They'll give me good feedback if it's not their deal, and they're not going to come in. They're not going to retrade the property unless it's just something that's outlandish that they couldn't find initially. So I mean, I think that's probably the biggest thing for those that move quick. Speed is very important. Feedback is great, and a lot of times we only have one or two shots. Because if they're a real seller, they're going to move the property probably pretty quick within a week or two. So I would say those things are probably most important.
Okay, no, appreciate that. And so if we you mentioned retrading, so just walk us through what that is, and when it's okay, when it's completely not okay.
So retrading is when a buyer asks for a credit on the price, or they ask the seller to fix a certain item that's wrong with the property that affects their value, or what they deem as the value. So I mean, many times I've had investors over the years and heard stories about investors retrading on things like that you would definitely see during a tour. I mean, even if you're not experienced with multifamily, put yourself in single family. If you're just going to go buy your personal home, like you're not going to tour through a home and say, well, I want a credit to the paint, or for the paint. I got to paint this whole house. Like after you go under contract, you've already seen what the paint color is. That's
Sure.
not. But if you go through a home and you don't see any signs of foundation movement, but there's major structural issues, then yeah, that's probably something that you're going to ask for a credit for, or to be fixed, because it wasn't expected. So definitely things that you would not want to retrade for are things that you can see in a tour.
Sure. Okay.
Like don't retrade for stab lock panels if you're going to have to replace old panels that are lender required or insurance company required to replace. If you saw those during the tour, don't ask for a retrade on a parking lot replacement. If that's like,
if you drove over it.
We've had that. So, but things like, most of the brokers are trying to provide as much information, at least I do, up front, because I want to try to manage that retrade process and make sure you want to set expectations as a broker, so those things aren't coming up during due diligence and blowing up the deal. So, I mean, if the roofs are 25 years old, I disclose that.
Sure.
And legally we're supposed to.
Okay.
If I know there's foundation issues, I'll probably expose that. So you can try to, have some kind of budget in there. I'd hate for you to go under contract or even in an access period, because we see that a lot. I'm happy to explain that.
Sure. Yeah.
And, a deal blow up because you said, well, I didn't expect this potential $200,000 to $300,000 repair. So I think setting expectations up front, it's definitely critical.
So you mentioned two things that I wanted to just see if we could dig deeper into. You mentioned, you're legally obligated to disclose. So what else are brokers legally obligated to disclose during the process?
Well, I mean, I guess anything that we know of that materially affects the sale of the property. Okay. If there's asbestos at the property, and we know about that, we've got to disclose it. If there's lead-based paint, and we know that, we need to disclose that. Okay. So, I mean, there's probably a whole list of things I can name, but I would say anything that materially affects the property that we know about as a broker, or the seller knows about, they need to disclose to us. And we need to disclose to the buyer.
Okay. And then you mentioned access period. So walk us through what that means.
Yeah. So in Dallas-Fort Worth, it's just the standard in today's market, and probably many other competitive markets across the country, to have non-refundable earnest money upon contract execution. And I think what most buyers are doing, and some sellers are privy to it and some are not, but they'll provide an access period. Maybe it's 7 to 10 days prior to signing the contract, or while you're negotiating the contract, to access the property with your contractors and maybe in a third-party inspection company, and just do a high-level, physical inspection. Like, what is the condition of the roofs? maybe you get a structural engineer to check out potential foundation issues, and really you're just trying to fine tune your capital expenditures requirement, to make sure there's nothing that you're missing that could really surprise you once you go under contract and you put that money at risk.
Okay. And then, just shifting to property tours, what are some do's and don'ts on a property tour?
Do ask very good questions. I ask a lot of questions, and I think many investors don't want to hear from the brokers, because I think the brokers are always trying to sell, but the manager will give you the real picture of the property. So, where do the tenants work in the area? What are some of the common maintenance issues with the property? If you had $500,000 or $1 million, what would you do with the property? Where would you improve it? What do you think is realistic for rents if we were to do this to the property? So, I would ask good questions to the manager. Definitely don't visit a property without a scheduled tour. I would try not to talk to tenants. Tenants are can be very open and they're going to tell all the issues about the property. That's fine, but there's probably a lot of rumors going around at the time of sale, and tenants are worried about what's going on. Are they going to knock this place down if it's an older property and build something new, or
Sure.
Are they going to jack my rents up? So I don't know. Those are just two things that come to mind as far as don'ts.
Okay. And then what are your expectations when someone comes to tour one of your listings in terms of, how much work they've done ahead of time?
I have the gamut, so I wouldn't say there's an expectation. Some people come with already a list of questions, which is great. And some people are, just come on site. The tours are quick and easy, and they're just seeing if there's confirming maybe expectations and seeing if there's anything that maybe something that they don't like about the deal that they'd want to pass on. So I've seen it all, and I really don't mind if you're really prepared or not prepared at all.
Okay. That's great. And then, as people put in an offer on the property, what are the key factors that you focus on whether to award one buyer group versus another?
So it's a mix of price and terms, but also along with terms, it's their credibility and surety of close. For example, I have a deal now that the seller can be a difficult guy, and I don't want to put another difficult buyer in front of them. So I'll get referrals. If I haven't worked with the buyer in the past I'll get broker referrals, and I'll reach out to those brokers and ask them how was their experience with them. Did they close on time? Did they retrade? Were they difficult to work with? And I want to paint the complete picture and give the owner or the seller all the information I can to help him make an educated decision. And of course, I'll give my recommendation as well, just based on the knowledge that I have.
Okay. And then you had mentioned hard money. What's typical that you see as a percentage of purchase price that buyers are offering?
It really depends on how competitive the deal is and how hairy it is. If it's a big heavy value add deal, I tend to see investors that are a little more hesitant with the amount of non-refundable money because there's a lot more uncertainty.
Okay.
But I would say, anywhere from 1% to 2% of the purchase price for non-refundable earnest money is pretty standard in Dallas-Fort Worth in today's market.
Okay. Awesome. And then are you seeing deals, take longer to close, fall out of contract? Can you just walk us through, what you're seeing out there?
I would say, it's tough for brokers to get top dollar in lower income areas that are probably 60s, 70s vintage with there's aluminum wiring or, Federal Pacific panels and some of these things. Those deals are not as competitive in today's market. Well, I'm sorry, what was the question?
Yeah, I guess just, well, let's continue on that. Why are those deals less competitive? Why is it hard to get top dollars
I think there's just more risk and uncertainty right now in today's market. We're 10 years long in the cycle. So I tend to see those deals not as competitive.
Okay. And then are you seeing things fall out of contract at all? And is there reasons why deals may fall out of contract?
No, I mean, there was a challenging time last year whenever Fannie Freddie hit caps, and many buyers had their loan proceeds cut. Maybe they originally sized for 78% loan to value with Fannie or Freddie, and all of a sudden they're getting cut down to 65 to 68%, whatever the case may be, because they reached their lending limits that year, or at that point in the year. So I did see some buyers that had to drop deals, or because they weren't comfortable with a bridge loan for the property, or they had to get a bridge or hard money to be able to close out the deal.
Okay.
But right now, I mean, it's a fresh start to the year. Interest rates are really low because that investor demand is very high, and I haven't seen any deals fall out.
Okay, awesome. And then if we shift over to markets, what are your thoughts on the DFW market, and what do you expect to happen in the next 1 to 3 years?
So, I mean, I love the Dallas-Fort Worth market. It's the market I know best. But also, I mean, we created over 100,000 jobs the last couple of years, each year. So I feel like we're a job creating factory. We're building a lot of units, but those units continue to absorb as companies and people move here. I feel like the economy is becoming more diverse in Dallas-Fort Worth this cycle. So that's great. And all in all, I mean, I don't think you can go wrong if you're buying anywhere around the DFW airport. That's Irving, that's the HEB area, that's Grapevine, North Arlington. Really like those areas.
Okay.
Obviously really like what's happening in Denton County, up in Frisco, and Denton, Texas, Louisville as well, even kind of North Louisville. So all great areas. But that being said, I expect this year to be very similar to last year. I think that's the investor sentiment, just with elections coming up at the end of the year, Trump putting pressure on the Fed. So interest rates, I think, will remain low about where they're at. But I don't have a crystal ball. I don't know what's going to happen in the next couple of years. My concern is the budget deficit, and I don't know if we need to dive into the weeds there, but we're at all-time record level debts, and you still see companies failing left and right, filing bankruptcy, and we're supposed to be in the greatest economy ever. So I think, with the budget deficit, there's interest rate risk. We could hit a blip and interest rates, shoot through the roof. And if interest rates go back up to 8%, then we're going to see 9 to 11% cap rates again.
Sure.
But again, no one has a crystal ball, and I can't predict the future. I think it's an incredible time right now to invest in real estate, as long as you're buying quality properties and quality locations.
Awesome. Any other tips there? I mean, you had mentioned, we're 10 years into the cycle. You like to be location, solid assets. Any other things that you like for where we are right now in the cycle?
As far as markets, or
just whether assets and markets. Yeah, you mentioned you like things by the airport, but anything else that you want to add on there?
I mean, I like a diverse unit mix, more 2 bedrooms than 1 bedrooms. As far as other markets, I've invested in Atlanta.
Okay.
And I really like the Atlanta story. But I think that's about it, other than what I mentioned.
Okay, awesome. And then what are you budgeting for organic rent growth over the next 1 to 3 years in your underwriting?
It's standard for us to do 3%. I mean, there was a time when, it really, depending on the submarket, we'd look at the data, and maybe, if it's trending at 6% year over year, in year 2 after increasing rents, we may go to 5% and 4% and stable at 3%. So in Dallas-Fort Worth, we stay at 3% rent growth.
Okay, awesome.
Yeah.
Mark, just kind of shifting to, kind of closing out the session here, and it's just been fantastic. What advice do you have for people getting into the business, both passives and perhaps first-time syndicators?
Again, it's a people business. So network. There's so many meetups in today's market. I mean, I wasn't around last cycle in the multifamily industry space, but hearing from guys like Todd Franks that has been a multifamily broker for 20 years and talk about the differences between the last 5 to 7 years versus 2000 to 2006. The digital age, information moves so fast. So we have a lot of people getting into real estate right now. I think because of that, there's a lot of marketing of quit your 9 to 5 and get into real estate. And that's great. I think real estate's an incredible vehicle. But what was the question again?
Just advice that you have for
this morning.
Advice you have for both passives and first-time syndicators.
Yeah. So I just network. I guess where I was just like going off on a tangent, but
which is great.
What I'm saying is because of social media, it's so easy to connect with people and figure out what meetups are out there, what weekend courses are out there. So there's plenty of information right now, even with books, investors writing books to learn about real estate. So learn as much as you can and network with as many people as possible. And I always say for new investors that are looking to put deals together, I mean, you can easily find people with more experience. If maybe you have a certain skill set, figure what that skill set is. Maybe you come from I've seen people from a private equity background and they're numbers driven. Well, they can underwrite deals all day. Well, maybe, you find an investor who can raise money really well, and you two can, have complementary strengths and, come together and buy deals.
Awesome. Mark, thanks so much for being here today. How can listeners get in touch with you?
I think LinkedIn is the best. You can reach out to me on LinkedIn or email. I mean, phone call is definitely not the best. My phone is ringing off the hook and I'm super busy. So LinkedIn, email is mark.allen. That's mark.allen @greystoneisg.com. And either of those two would be great.
Awesome, Mark. Well, thanks so much for giving up your Saturday morning to be with us. This was so insightful, and we really appreciate it.
Yeah, thanks, Ryan. I appreciate all the detailed questions. Love them.
Thanks again, Mark.
All right.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.